Hello, friends. The topic for the day is reverse mortgage loan in context to a special product, which is like actually it is an annuity enabled product. Now, it is also called as a hybrid product. Why? Because you see, normally reverse mortgage is a contract between a borrower, which is actually a house owner, and a bank. But in this case, the product is slightly different, where you see the bank is going to give you the borrower upfront like payment of the total money in lump sum, and this lump sum amount is not actually given to customer, rather it is given to insurance company. Okay, the other service provider who is going to give who is going to utilize this total big corpus of money into investments into market, and market linked returns will be given back to the client. So uh, market linked return means this is going to be a little bit variable value, which is may have a volatility element into it. Okay, but because these are fund managers with experience, so on an average the return that we are going to get through market return will be much better than what bank is going to give you in a conventional reverse mortgage product. Let's go in. A reverse mortgage is actually a product, but here it is actually annuity enabled loan. Okay, a reverse mortgage with annuity enabled in it, whereby you're given your amount in advance, is called as this reverse mortgage plan with annuity in it. Now, in this, what is happening is like I already said, lump sum amount of money will be given by bank to insurance company, and the interest is charged on the upfront fee. Means bank is going to keep their margin; they are going to deduct the interest element, and whatever is your residual value will be given to insurance company. Now, what is happening is like now here, insurance company will take your money and will invest in market. You have heard about ULIP plan, unit linked insurance plan. So let's say in this case also your money is totally going into a ULIP plan, unit linked insurance plan. So you see here it is not insurance that we are doing. Here it is your return that you are expecting from an insurance company. So they are going to use their lump sum amount of money to make a portfolio according to your risk inclination or your risk tolerance limit, and will give you return according to the performance of the market. Okay, the market which is your particular interest area. So this is what we have. So in regular reverse mortgage product, what you have is like you get it regularly in installments, that is periodic installment, not in lump sum. Lump sum is only given when you have a medical emergency, but under this particular scheme you're getting your interest levied on the total amount, you know. This is like a negative of it, but point is like because you have taken everything in lump sum on upfront date on first installment itself, hence bank has nothing to keep it with them, so they have to charge it from day one. But in second case, which is a regular reverse mortgage, a normal reverse mortgage case, there you see bank is paying you in installments, so they have not paid you the total amount in lump sum, so they'll charge you only on your outstanding value. Okay, they'll charge you, so the interest obligation is going to be less in reverse mortgage conventional product. So this is the difference. So next is like you see higher payouts are possible through this particular product. Why this is possible? This monthly payment is called annuity, and it is typically higher than monthly payout that you're going to get from your bank in the name of regular reverse mortgage. You see, the only thing is like market force is what is important. What is driving your market? Is it equity, or is it debt, or is it a balanced portfolio between two? You see, they people are fund managers, they'll manage your funds very wisely. So whenever there is a need, they'll shift the allocation accordingly. And you see, they don't do it of their own. They have given you prior intimation for the same. Okay, so they'll be doing it. So if you look at your current market players, Star, Union, Daiichi Life Insurance Company, in association with, you see, Union Bank of India and Central Bank, they are offering this particular hybrid product in India. Now, if you look into this example, this is an example where I've quoted my professor's name, Dr. Prahlad Rai Agarwal, who is a retired fellow. I've reduced the date age from the actual age to 60, because in this case for a retired fellow he needs to be at 60 so as to calculate the installments, and then eligibility is asking you to have this. Let's say he's having a property of rupee 1 crore and he's willing to take reverse mortgage scheme. What will be his payouts in normal scheme, and what will be his payouts in you see this annuity enabled scheme, which is given by a few, not by many. So you see, house property value is 1 crore, age is 60. Let's say average rate of interest is 12.75. On this, on these assumptions, if you look into, we are trying to compare it for both. So payment period for regular normal reverse mortgage case is 20 years. So 60 to 80 is what the period bank is going to pay you something. Okay, but in case of annuity enabled, what you're doing is like you have given you lump sum money to your insurance company. So insurance company is going to hold your portfolio, and your portfolio returns will be given to you at periodic interval. So you see, you don't have any timeline here. So for bank it is 20, but here it is infinite. You may live for 30 years, 40 years, 50 years. On one side you're getting a cover from your bank where they don't take your property away from you. So you have your cover for your house property where you will stay till your last. Second is like in terms of return, you have these companies who are giving you your return lifetime, not for first 20 years. So it is a limitation in reverse mortgage, normal case. Okay, loan to value ratio. You see, in loan to value ratio, reverse mortgage is going to win because there you are going to get 90% of exposure. But because annuity enabled program is where you get it in lump sum on upfront first, at the start of your scheme. Hence, you see here your value loan to value ratio is going to be very less, 55% only. So you pick whatever you want. You have some plus, you have some minus. Okay, loan value here in this first case is 90 lakhs. In second case, it is going to be 55 lakhs. So 55 lakhs will be given to insurance company. They will be using it and will be giving you return according to 55 lakhs. Okay, but in this regular reverse mortgage case means what is going to happen is based on 90 lakh rupee as your total compensation amount, they'll calculate it for 20 years monthly installment, equated monthly installment, and bank will give it to you in your account. Okay, so lump sum payment to borrower can be made only in times of medical emergency. In this case, if it is 1 crore rupee, you can get up to 3,56,000 rupee. Okay, this can be value addition. But in case of, you see, annuity enabled plan will give you a better return, that is 13,75,000 rupee. So I feel like this second plan is very dynamic, is giving you better returns. Then only thing limitation here is like the interest rate is little bit higher because you have to, like, you are getting everything on day one. Monthly payment in reverse regular mortgages 8,218, whereas for the second revised plan is like, see the difference, and there is a star on it. What it means, like, this is subjected to market rates. Market rates may change. So during crisis period, this value may be a problematic thing. So during crisis, I suggest reverse mortgage is good. In booming period, this second product is strongly recommended. Amount to be recovered by bank upon the death of the borrower after 20 years. Let's say your relative would like to take this property back. So in case of a bank, it is easy. You know, it is for 90 lakhs, so you have to pay it 90 lakhs. But in case of the second product, which is very like a reverse mortgage loan enabled annuity, if it is there and you're getting an annuity of 24,709 rupee in every month, you see what you're going to get is like you have to pay a very heavy amount of settlement price, which is 6.4 crore. So it is better. What is like you? Why are you supposed to close it? It is better you leave 55 lakh rupee with insurance company and need not to recover anything out of it. And just to clear this loan, you have to pay a loan amount. You see, why are you trying to clear this loan? Let's try to understand. Because you would like to retain the property. So what you can do is like you can take a rational call on a future date. Any your kids, your next generation people can take a call by looking into the current price of your property in market. If it is more than 6.5 crores, you should go for it. Clear the dues, get the balance amount. If it is less than 6.4, you should not be going for it. Let insurance company enjoy it. Let bank enjoy it. The bank has already given the money to insurance company. What is there with insurance company? They have a portfolio of 55 lakhs, which we gave on day one. So they have it, and from that money only they are giving it back to us. Okay. So with this, I come to a conclusion. Like you see, both products do have their merits and demerits. So looking into the state of your economy, looking into your own risk taking capacity, you can decide.